We have all known for quite some time what the World Economic Forum is, what they stand for, and what lengths they are ready to go to in order to implement the Great Reset. We have reached what appears to be a breaking point, a point of no return, where the WEF and those in control can no longer pull the strings from behind the scenes, and must instead try to convince the world of their good intentions. As the average person has become more aware, we have also become angrier, and people have begun to push back, and have been pushing back for some time. Welcome to Financial Fortune, the channel where we unravel the complexities of the global economy and provide insights that shape your financial decisions. In today's eye-opening video, we delve into a significant event that has sent shockwaves through the global stage. Join us as we explore the recent failures of the World Economic Forum and examine the implications for the elite and the world at large. Brace yourself for a captivating analysis as we navigate the emerging landscape of global chaos. This is Financial Fortune. Actually, things aren't going very well at all. And backing for the WEF and central banks has evaporated at a remarkable rate, bringing the WEF to the verge of collapse as its supporters crawl back into the pits they came from and humanity celebrates. But the saga continues. The demise of the WEF is just in its early stages at this point. Now, central banks have always been around under the guise of being here to do good, under the belief that they are indispensable and that without them, our financial systems would cease to operate for a very long time. Some estimates put the number of individuals who hold this view at well over 90%. The mask has begun to fall in 2023, though, and the truth is beginning to emerge. However, the shift did not begin this year or even a year or two ago. In 2008, it all began. You've heard this before. Big housing bubble, that's all I've got for you. 10 houses with 0% interest for people with no money to pay the mortgage. As a result, home values begin to plummet and the bubble bursts. Extremely indebted banks fail, the global financial crisis ensues because the ripple effect is so absurdly large, and the Federal Reserve comes in to rescue the day. And they launch quantitative easing, which is really simply printing money with some fancy terms thrown on top to fool the uninitiated. The outcomes are mediocre at best, but not catastrophic. Printing a few $1 trillion isn't going to get the economy flowing again anytime soon because of how deep and powerful the recession is. Things sort themselves out, though. A major bull market begins, but prices don't surge. Since interest rates had previously been lowered to 0%, the vast majority of QE that was implemented flowed straight into asset values. Everything was financed by debt, therefore the high asset values had little to do with the high cost to purchase such assets. That's why inflation has been low. But the groundwork was laid, and the yen's introduction to the Federal Reserve and other central banks represented the beginning of an era. When the secret epidemic finally hits in 2020, the globe will have shut down, and the economy will be on the verge of its biggest collapse in human history. However, the Federal Reserve and other central banks have once again intervened to ensure the safety of the market. The Fed begins raising interest rates, and the economy and stock markets tremble.
The Federal Reserve went ahead with a 25 basis point rate hike, even as banks tighten credit. Will these forces push us into recession? With this banking crisis, or mini banking crisis, lending standards have been getting very tight, and I've heard anecdotally that some of the smaller community banks have almost shut the door. With those two things combined, how much will that slow the economy?
Right, well, that's the big open question, and I think to some degree this should be expected. This is one of the main channels through which the Federal Reserve can slow the economy. So we should expect lending standards to tighten. We should expect loan growth to slow. The question is essentially, have recent events meant that we're going to get a lot more tightening than we thought? So excess tightening or unanticipated tightening. So is there a credit shock, a credit crunch around the corner? So it's true that loan growth was slowing coming into this event. It'll probably slow further. And so if we get a lot of excess tightening, yes, it's going to do some of the Fed's job for them, and I think the Fed said that this week.
Yeah, Jay Powell did, yeah.
But he essentially mentioned that, and yeah, so it's probably a disinflationary shock in that world, so the Fed may have to tighten less. slower loan growth or even declines in loan growth would help the economy slow down and bring inflation down.
So when you combine those with the 25 basis point hike and all the other hikes we saw before that, has the Fed essentially been too aggressive? If you look at year over year, inflation's pretty high. But if you look at more recent indicators, I mean, Case-Shiller housing index has been down 6 straight months, and I think everyone expects next week we'll see a 7th straight month. That's worrisome.
It is. I would say it's too early to know. I don't think the Fed's done too much. Certainly housing has slowed. Business spending on structures and equipment, that slowed. Manufacturing production has started to come off. So this is kind of the next step. Bank loans and standards are tightening. Credit growth should slow. It's hard to argue we've over-tightened if we just added 311,000 jobs. So essentially, it's an investment-led slowdown right now. We suspect it'll transition to a consumer slowdown later this year. I don't think the Fed's overdone it, but we'll see. We could get a very large negative shock to credit growth out of this, and the Fed could have to backpedal. But right now, the data doesn't suggest that's the case.
Well, certainly the jobs is that one thing that has really held up to some people's surprise. You, however, have been predicting a mild recession, or at least you said the odds are pretty high of a mild recession. Anything in this past week change your mind, make it more likely?
I would say the events of this past week have opened up downside risks to our outlook for the first time in what I call the reopening phase of the pandemic, when the economy has just shown a lot of strength and wanted to keep going. So I would say kind of it's twofold. One, the path from housing to business spending to manufacturing to bank lending, that's very consistent with the slowdown, so it makes me comfortable with our outlook overall. But I do think these events represent downside risk to the economy, which could mean the Fed, there are worlds in which the Fed's going to have to shift to precautionary rate cuts as it's done in the past, or maybe even move to outright rate cuts quicker. We'll see. But yes, it makes me kind of feel comfortable with where we are.
Okay, so in addition to fighting inflation, I think the Fed's original mandate back in the early part of last century was actually stability in the financial sector, and now suddenly that's a real issue. How do they find a balance between not wanting a run on the banks, but also not giving bankers an open door to take lots of risks because, hey, the federal government will backstop it, the so-called moral hazard? The
moral hazard argument, right. So certainly first and foremost, you do have to respond to events if you think that there's a systemic risk event there. That's essentially what they've done. And you're right, that was the Fed's original mandate. In some ways, and I don't want to make this overly literal, in some ways it's good that the shock happened in the banking sector. The Fed's good at understanding these issues. It has the tools to go fight them directly and the experience. So I think there's experience there that should help us out. But you're right, every time we do that, it raises the risk of moral hazard. What will likely be coming down the road then is additional regulation. Maybe, to some degree, the reversal of the rules in 2018 that reduced regulatory burden on banks with 50 billion to 250 billion in assets. So in general, you come back with typically more regulation, and to hopefully that you ensure the incentives between bank owners and their shareholders.
As long as it's smart regulation.
That's right.
They missed it this time around. One more question for you, a few seconds left. It seems that there isn't much reason, if I'm being mercenary about it, to go with a small bank right now. If I had a big payroll to meet, I might think, gee, I'd like to put that with one of the too big to fail banks. Is there a danger that money will continue to flow out of the smaller institutions?
Yes, I think you could argue high yields on money market mutual funds are causing deposit outflows, and recent stress events could lead some deposits to flow into bigger banks. I do think that will be an ongoing challenge over time.
And that concludes our compelling analysis of the recent failures of the World Economic Forum and the onset of elite global chaos. We hope this video has shed light on the evolving dynamics of the global stage and their potential impact on your financial journey. Remember to like, subscribe, and hit the notification bell to stay updated with our latest videos. At Financial Fortune, we remain dedicated to providing you with reliable insights and helping you navigate the ever-changing economic landscape. Thank you for joining us today. Until next time, may your financial decisions lead you to lasting fortune. This is Financial Fortune, signing off.